The silver price is lying to you right now, and the physical premium is the part telling the truth. You're watching a screen that looks calm, almost bored, while the real-world cost to actually source ounces quietly creeps higher. And the conflict is the whole story. Because when spot stalls but premiums rise, it's not a cute anomaly. It's a signal that stress is migrating from the headline to the plumbing. And if you understand why that migration happens, you'll know exactly what to watch over the next 72 hours, what level matters, and what breaks, first in the paper market and then in the real one. Here's the clean version of the paradox. Spot is the reference price for a financial instrument. Premium is the price of immediacy, certainty, and distribution. Spot is what you see. Premium is what you pay. Those two can drift apart for a while. But when they separate in a specific way, flat tape, rising premium, it usually means one thing. Someone in the chain is charging you for risk that isn't DE obvious on the chart yet. And that's where the real pressure starts. Most people treat premium like a retail nuisance, like shipping fees or dealer greed. That's a mistake. Premium is a stress gauge. It is a compressed summary of all the things the screen price doesn't have to care about. Fabrication capacity, dealer inventory, restock lead times, hedging costs, liquidity, and the simple fact that a warehouse number on a report is not the same thing as a deliverable coin in your hand. Spot can sit still because futures liquidity is deep and because big players can express views with swaps, options, and ETF shares. But a dealer doesn't get to settle your order in paper. They have to deliver a product. And when that product becomes harder or riskier to source, the premium is the first place the truth leaks out. Now, why do the next 72 hours matter? Because we're walking into a cluster of calendar pressure where silver can go from sleepy to violent without warning. Into late January, you tend to get thin liquidity pockets, positioning adjustments, and hedging flows that don't move in smooth lines. You also have an options and delivery calendar that can turn small moves into forced moves. Add a Fed week into the mix, and you get something dangerous, a market that looks quiet, right up until it doesn't T. And if you're only watching spot, you'll get blindsided. But that's not the part that matters. The part that matters is what the structure forces participants to do. Let's drop the hidden detail now, because everything else builds on it. A rising premium during a flat tape often means the market is charging you for time and certainty, not just metal. Think of premium as an embedded insurance premium plus a volatility surcharge, plus a Donna T, blame me if the next truck doesn't T show up in markup. When volatility is expected to rise, when restocking windows are uncertain, when the chain is nervous about being short, physical, into a sudden jump, the premium expands even if the headline price is pinned. That's the reframe. It turns spot stalling from a comfort blanket into a warning label. Here's how premiums actually form in the real world. First, you've got fabrication, turning raw silver into bars and coins. Then distribution, moving product through wholesalers to dealers. Then inventory financing, carrying stock costs money, and that cost changes with rates and credit conditions. Then you've got spread and execution. When the market is jumpy, the bid-ask widens because nobody wants to quote tight prices they can't hedge. Finally, you have hedging friction itself. Dealers hedge their inventory and their expected inventory with futures, options, and sometimes just by widening spreads and slowing sales when the tape feels hostile. So even if spot is flat, the premium can rise because everything around spot got more expensive or more dangerous. And that's where the conflict between paper and physical shows up cleanly. Paper price discovery happens in futures and ETF ecosystems where the marginal trade can be enormous and instantaneous. Physical pricing happens in a world of trucks, mint schedules, and cash flow reality. The paper market can be heavy with selling for reasons that have nothing to do with the real-world supply chain, like portfolio rebalancing, macro hedges, or a quick risk-off move. Meanwhile, the physical market can be tight for reasons that never make it to a headline, like a bottleneck at a refiner, a surge in retail demand, or dealers choosing not to replenish aggressively into a volatile week. Same metal, two different pipes. And when those pipes stop agreeing, it's rarely meaningless. Now let's talk about the screen price stalling, because the stall itself has a mechanism. Into expiration windows, especially when there's a lot of options, open interest clustered around specific strikes, price can get magnetized. This is not conspiracy, it's mechanical hedging. If dealers are net short options to customers, they hedge their exposure dynamically. When gamma is high near key strikes, small moves in price force dealers to adjust hedges quickly, buying into rallies, selling into dips, or the opposite, depending on positioning. That hedging can create a stabilizing effect around certain levels, a kind of gravitational pin. It can mute the headline tape even while physical conditions keep tightening. And the next detail is what flips the whole setup. Once the pin breaks, or the options roll off, the hedging flow changes shape. Suddenly, the same structure that held price still can help it move faster. So what does that mean in plain terms? It means you can get this exact configuration. Spot looks boring because it's S trapped in a hedging corridor, but premiums rise because the people who deliver metal are staring at an imminent volatility event and charging you for the risk. They're not predicting a moonshot. They're managing survival. They widen premiums to avoid getting caught short. They slow sales. They reprice quietly. And that's your tell. If you want to see stress without guessing motives, look at term structure and spreads. Don't ask, is spot up? Ask, what are nearby months doing versus deferred months? When the market expects near-term tightness, the front can firm relative to the back. When financing and inventory are comfortable, the curve tends to reflect carry costs. You don't need to be a quant. You just need to understand the translation. The curve is the market. S, way of pricing time. And when time gets expensive, something is changing beneath the surface. Because if this one part of the curve shifts abruptly, the math changes for arbitrage, for carry trades, for anyone holding inventory, and for the people who can deliver, and that eventually bleeds into spot. Now, inventories. This is where people get fooled with headlines. You'll hear, there's plenty of silver in warehouses, and that line can be true and still miss the point. The only inventory that matters during stress is the inventory that is actually positioned and willing to satisfy delivery at the reference terms. There was a difference between silver that exists and silver that is available to be delivered without drama. Warehouse categories matter. Deliverable categories matter. Sometimes inventory is there, but it's not offered. Sometimes it's earmarked. Sometimes it's owned by parties with no incentive to sell at the posted terms. That's not a scandal. That's market reality. And when deliverable availability tightens even a little at the margin, the chain downstream reacts by charging more for certainty. Premiums rise, not because the world is out of silver, but because the world is short confidence. And here's the piece that ties everything together this week. Institutional flows. ETFs and large funds are a financial pipeline. When demand hits the ETF complex, shares are created and metal can be allocated. That can tighten the available float in specific places at specific times. It can also influence the lending environment, leases, swaps, and borrow rates. Again, you don't need a conspiratorial narrative. You just need the incentive map. If institutions want exposure quickly, they often prefer paper. If paper demand spikes, it can still ripple into physical sourcing. Meanwhile, dealers aren't sitting there with infinite inventory. They respond to what they can replace. If replacement feels uncertain, premium rises. The market is quietly telling you who's comfortable and who's not. Let's get even more grounded. Silver supply doesn't respond quickly. This is not like flipping a switch on a factory. A meaningful chunk of silver production is tied to other mining economics. Silver comes out as a byproduct of base metals. So even if silver's economics improve, it doesn't automatically mean a flood of new ounces next week. Refining and fabrication have capacity constraints and scheduling constraints. Recycling exists, but it has limits and time lags. And so the near-term reality is often shaped by flows and logistics more than by geology. That's why premiums can move before spot. The chain is reacting to what it can actually get done in calendar time. Now add the macro layer, because it's the amplifier. Silver trades two personalities, industrial input and monetary metal. When rates and the dollar swing, silver can behave like a risk asset in the short term, getting slapped around by liquidity, by macro positioning, by the same sell what you can reflex you see in broad risk-off moments. At the same time, the longer narrative can be supportive. Inflation expectations, currency stress, reserve debates, geopolitical supply chain risk. Those forces don't always show up on a 2-hour chart, but they do show up in behavior. Who is accumulating, who is hedging, and how the physical chain prices uncertainty. And this is why the next 72 hours matter. You're in the zone where a macro catalyst, especially a Fed week, can jolt rates and the dollar, and that can jolt the paper price. But the physical premium is already moving. That tells you the chain is bracing. The market is calm on the surface and tense underneath. That combination is exactly what produces gap risk. Not guaranteed, not promised, but structurally possible. And when something is structurally possible, you prepare for it. You don't get emotionally surprised by it. Let's walk through what can cause premiums to rise, even if spot stalls in a way that doesn't rely on speculation. 1. Dealers experience faster turnover and don't want to restock aggressively into an uncertain week. 2. Wholesalers widen prices because their own hedging costs rise or their availability tightens. 3. Fabrication schedules get longer, even slightly, and that changes the risk of being out of stock. 4. Volatility expectations rise, and dealers charge more to quote a firm price. 5. The market's liquidity thins, and spreads widen because execution risk rises. That's 5 separate mechanisms. None require a shadowy villain. All are consistent with what you see. Flat tape, rising premium. Now, counterpoints, because credibility lives here. Rising premiums do not automatically mean an imminent shortage. Sometimes it's just a retail panic bid. Sometimes it's a temporary mismatch where wholesale hasn't caught up to spot moves or vice versa. Sometimes it's a normal seasonal shift. Sometimes it's dealers protecting themselves after getting burned by quick reversals. Sometimes it's product specific. One popular coin gets tight while other forms are available. That's the mature view. You don't turn one data point into a prophecy. You build a stack, then you watch what confirms or fades. So what's our proof stack right now without pretending we have perfect real-time data on every single metric? First proof point, the divergence itself, premiums rising while spot stalls, is a behavioral signal from the distribution chain. Second, the calendar pressure, options and delivery windows cluster into late January and can create mechanical price behavior. Third, the market structure mechanism, gamma hedging can pin price temporarily and then release it. Fourth, the inventory nuance. Deliverable availability matters more than total stock. Fifth, the macro catalyst. Fed week can create a rates dollar shock that moves the paper price while physical remains sticky. Sixth, the institutional channel. ETFs and large exposure vehicles can influence the financial pipe and spill into physical. That's 6 layers: mechanism, calendar, structure, inventory reality, macro, and flows. That's why this setup deserves attention. Now let's talk about what this forces participants to do, because that's how you convert theory into a tradable narrative without giving anyone a fantasy. If you're a dealer and premiums are rising, you're likely tightening your quoting and managing your inventory risk. You might slow promotions. You might raise as low as prices. You might limit quantity. Why? Because if spot suddenly jumps, you don't want to be short at the wrong moment. If you're a fabricator, you're prioritizing throughput and scheduling. If you're a futures trader, you're watching strikes, watching open interest, and watching the tape near expiry. If you're an ETF participant, you're watching flows and the cost of exposure. Everyone is watching risk in a different way. And when different parts of the ecosystem react differently, divergences appear. The premium divergence is a symptom of that multi-ecosystem reality. Here's a simple way to visualize it without getting lost. Picture spot as the scoreboard. Picture premium as the price of a ticket to the stadium when demand spikes and seating is limited. The scoreboard can show a tied game. The ticket price can still double because everyone suddenly cares about being inside right now. That doesn't mean the game is over. It means the demand for certainty changed. And markets are, at their core, auctions for certainty. But that's not the part that matters. The part that matters is what happens when the scoreboard finally moves in the same direction as the ticket price. That's when the move can feel sudden, even though the stress was there the whole time. Now, let's get tactical about what to watch next, because attention is fragile and the market punishes vague narratives. Over the next week or two, you're watching for one of 2 shapes. Scenario 1 is the controlled pullback and retest. Spot remains choppy, maybe even dips, because the macro tape is messy and paper flows are heavy. But premiums remain firm. The curve doesn't fully relax. Dealer behavior stays cautious. That would mean the physical bid is persistent, even if the paper price wants to shake people out. In that scenario, the bullish case isn't straight up. It's support holds, demand absorbs, and the market refuses to fully unwind. Confirmation looks like dips being bought quickly, intraday sell-offs failing to follow through, and premiums not collapsing. Weakening looks like premiums easing rapidly, availability improving, and the curve relaxing, meaning the urgency for time disappears. Scenario 2 is the continuation squeeze with gap risk. This is the scenario where the pin releases. The paper market gets a catalyst, rates move, the dollar moves, positioning shifts, and price breaks out of the hedging corridor. Liquidity thins, shorts cover. Dealers hedge in a hurry, and the move accelerates not because everyone suddenly believes, but because the mechanics force buying. In that scenario, you'll see price jump in a way that feels unfair. That's how squeezes work. The confirmation is speed, a clean break and continuation, not a slow grind. The invalidation is a failed break that snaps back into the range and stays there while premiums soften, because if the squeeze is real, it tends to keep pressing until the forced flow exhausts. And if the forced flow isn't there, the market often reverts. So what are the levels? I am not going to fake precision with exact numbers I can T-verify in your live feed, because that's how you lose trust. But you don't need exact numbers to have a framework. You need zones. You need structure. Identify the most recent range that S has been containing spot, the ceiling that keeps rejecting rallies, and the floor that keeps catching dips. That ceiling is your math changes line. Above it, hedging flows and stop orders can flip from dampening volatility to amplifying it. The floor is your the story pauses line. Below it, the tape can turn into a liquidation event even if the longer thesis remains intact. And at S, where most people get emotionally destroyed, they confuse a volatility event with a thesis collapse. The next detail is what saves you, your ability to separate trend signal from noise. Here's the psychology shield you need, because the market will use volatility against you, even if you're directionally right. Silver is a specialist at emotional manipulation. It does fast spikes to trigger FOMO, then sharp dumps to trigger regret, then a grind to boredom, then another spike. That's not personal. That's the nature of a thin, leveraged, globally traded metal with multiple identities and lots of derivatives. If you treat every red candle as betrayal, you'll get chopped. If you treat every green candle as validation, you'll chase. The skill is to decide ahead of time what matters: the structure, the curve behavior, the premium behavior, and the reaction to key calendar events. Everything else is noise trying to steal your focus. A simple discipline: define what would change your mind, not what would scare you, what would actually invalidate the setup. For this story, premiums rising while spot stalls. Invalidations are straightforward. If premiums collapse quickly back to normal while spot remains flat, that tells you the chain is no longer charging for urgency. If availability improves and dealers start discounting aggressively, that's easing stress. If the curve relaxes and nearby tightness disappears, that reduces the time as expensive message. If ETF flows fade and macro tailwinds turn into headwinds, that can weaken the upside pressure. Those are measurable. That's logic. That's how you avoid getting emotionally hijacked. Now, let's address the elephant people love to drag into silver: suppression. Here's how to talk about it in a finance credible way. Markets have incentives. Big participants manage risk. Dealers hedge inventory. Funds rebalance. Options positioning can pin price. None of that requires a single mastermind. You can have outcomes that feel like suppression simply because the structure rewards certain behaviors. If large players are short volatility or positioned around certain strikes, the market can gravitate. If liquidity providers pull back, price can snap. If the paper market is the marginal price setter, it can lag physical signals for a while. Those are structural realities. Focus on the incentive map and the mechanical flows, not a courtroom drama. Because if you do that, you can actually anticipate what comes next. So what comes next, specifically in the near term? Over the next 72 hours, watch how silver behaves around the range boundary. Not the midpoint, the boundary. Watch whether rallies are sold instantly or whether they start to stick. Watch whether dips are absorbed or whether they cascade. At the same time, watch the premium environment, not obsessively refreshing one dealer, but observing the general behavior. Are premiums still rising, still firm, or easing? Watch whether the market feels tight in real sourcing terms. Watch how spreads behave when spot moves. If spot pops and premiums instantly widen more, that's the chain saying, we don't trust this to stay calm. If spot dips and premiums don't budge, that's the chain saying, we're not discounting your fear. And that is a very specific message. Then, as you move into the next week, you watch for the scenario fork, controlled pullback and retest, or continuation squeeze. If it's a controlled retest, the market will try to shake you with volatility, then fail to break the structural floor, then rebuild. That's the boring bullish path. If it's a squeeze, it will feel like the market is running away without you. That's when your job is not to chase a candle. Your job is to understand whether the move is being driven by forced flows that can persist. You look for continuation after the initial pop. You look for the market to hold above the broken range. You look for dips being shallow and bought. If you see that, it's not emotion, it's math. But if you see a spike and immediate collapse back into the range, that's a warning that the move was a liquidity event, not a regime shift. And this is where people mess up with silver. They want one story. Silver is two stories at once. It can be in a longer uptrend while still performing vicious shakeouts. It can be fundamentally supported while still getting hammered on macro days. It can be tight and physical while paper plays games around expiry. Your edge isn't predicting every candle. Your edge is recognizing which story is dominant at a given moment and which metrics are leading. Right now, premiums are acting like a leading indicator. Spot is acting like a lagging indicator pinned by structure. That's the thesis. And the next 72 hours will test whether that divergence resolves bullishly or fades. Let's make it concrete. What would bullish resolution look like? It looks like spot breaking the range ceiling and holding, with premiums staying firm. It looks like the curve refusing to relax, signaling near-term demand for time. It looks like selling attempts failing quickly, like the market is absorbing supply. It looks like volatility picking up in a way that favors upside continuation, not just random chop. And you'd all feel it in the tape. Liquidity thins, and then price starts moving in increments that make the old range feel irrelevant. That's when you want to be calm, not euphoric. Because euphoric people chase, calm people execute. What would bearish resolution look like? It looks like premiums easing back down even while spot remains stuck or drifts lower. It looks like dealers getting comfortable again, tightening quotes, offering better terms. It looks like the curve easing, the urgency fading. It looks like rallies being sold with follow-through and dips not being defended. That doesn't mean silver is dead. It means the specific premium stress story is cooling. And if your entire identity is tied to one story, you'll miss that. Stay attached to the process, not the prophecy. Now, one more layer that matters: the way volatility will be used against you. Expect headline whiplash. Expect intraday reversals around macro announcements. Expect social media to declare victory and defeat every 10 minutes. That noise is designed by the market structure, not by a person, to shake out weak hands. The leverage in the system means price often overshoots both directions. So you need a rule. Don't let a single candle rewrite your thesis. Let structure rewrite it. Let the premium behavior rewrite it. Let the curve rewrite it. Let the post-event reaction rewrite it. Reaction is information. Headlines are entertainment. If you want a simple next week checklist, here it is in spirit, not in the form of a rigid script. 1. Is spot still pinned or did it break range? 2. If it broke, did it hold or did it snap back? 3. Did premiums stay firm through the move or did they fade? 4. Did the curve show urgency or did time get cheaper? 5. Did the market show signs of forced buying, fast continuation, shallow pullbacks, or just a one-off spike? 6. Did the macro catalyst change the regime or was it absorbed? If you track those 6, you won't need 1,000 opinions. You'll have your own. And here's the subtle community piece, because it matters more than people admit. Stick with the crowd that watches the plumbing, not just the headline. The metals crowd gets mocked because it refuses to trust narratives. Good. Skepticism is a feature when it's disciplined, but skepticism without a framework turns into doom scrolling. The framework is the bridge. Structure, spreads, inventory nuance, flows, calendar pressure, and risk management. That's the toolkit. That's how you stay sane while the market tries to make you impulsive. So the verdict stands. Spot looks calm. Premiums are rising. The chain is charging for certainty. The next 72 hours matter because a calendar cluster can flip the mechanical flows that are currently muting the tape. You don't need to predict a miracle. You need to recognize a setup where the risk is asymmetric, where the quiet can break into a move that feels sudden because the stress has been hiding in the premium all along. Watch the range boundary. Watch the premium behavior. Watch the curve and the reaction to catalysts. And decide your invalidation level before the market tries to decide it for you.